Hello, everybody. Luke Gromen, FFTT. Hope you are well and having a great week. It is beautiful weather here in Cleveland, finally. We were in the 80s today, which, if you've ever spent any time in Cleveland, it's a time of year that you treasure because you've been through a long, a long winter. So hopefully you're having a great week. I'm going to jump right in the interest of brevity. As always, thank you very much for submitting questions. Really appreciate it. Love the discussion. First question is from JH. Do you think a long period of nominal U.S. equity weakness is possible/likely, such as 1929 to 1955, 1966 to 82, 2000 to 2013? And then secondly, is there any Goldilocks scenario that involves U.S. dollar/U.S. Treasury remaining the preeminent reserve asset, U.S. industrial onshoring, U.S. stocks up, and inflation mild? In dollar terms, I do think it is possible to have nominal equity softness for a long time. I think it's possible, but I don't think it's very likely. In gold terms and in Bitcoin terms, I think it's very likely that we are in the early days of an extended period of weakness in equities in gold and Bitcoin terms. So if you think about it, back 1929, 1955, remember, 1929 to 1933, the weakness in equities was not against the dollar. It was against the gold-backed dollar. In other words, it was against gold. And so, yes, we were off gold from 33 to 45, but then we were back on gold from 45 to 54. So a good chunk of that time, you had equity weakness against gold. And so I do think we'll see some period like that again. Same thing, 66 through 71. So in terms of the why you're unlikely to see it in dollar terms, remember, ultimately, stocks de facto back the U.S. Treasury market via the consumer spending link, which is tied in with net capital gains, taxable IRA distributions, stock options. So nominally weak equities for too long a period of time creates nominally weak GDP. It creates nominally weak consumer spending. It creates weak receipts, increasing deficits, increasing treasury borrowing, which ultimately, given where we are, creates treasury dysfunction before too long. And that's generally addressed with with new dollar liquidity, as we've seen repeatedly at various intervals over the last 5-6 years. And once they inject dollar liquidity, it makes it tough to have nominal weakness in stocks persist for very long. So that's why I think nominal dollar equity weakness is unlikely, but in gold and Bitcoin terms, pretty likely. The release valve much more likely to be the dollar, and in particular versus gold and Bitcoin. In terms of the Goldilocks scenario you laid out, I don't think the U.S. can do that, barring some sort of major technology shift that pushes us way ahead of everybody else and sort of is the way to create a bargain that you can get people interested in buying bonds. I would be happy to buy bonds at low interest rates if I had access to extremely cheap energy forever. That's a trade-off you could do. I could build a low-cost factory base versus China with that. But otherwise, I think we're likely to see what, to my eyes, appears to be happening, which is an acceleration of a system that's moving away from treasuries as primary reserve asset towards gold and a more multilateral world. Next question is from ED. What does it mean when you say endgame if the current administration does not follow the order of operations that you first prescribed? As a reminder, the order of operations is you got to devalue debt to GDP one way or another, significant negative real rates, revalue gold, buy down debt, before you try to do anything drastic. Doge, or as it turns out, as we've seen in the last month, tariffs. The end game is ultimately, I sort of dislike that phrase. I know it's used a lot because the game never really ends. The rules just change. So what that looks like is rates up, stocks down until the Fed's forced into some version of yield curve control to contain yields, or Treasury does same. to contain yields because debt to GDP is so high that the U.S. government cannot afford yields above some certain level. And if it's ultimately, that can spread to other sorts of debt. We saw that in 2020 when the Fed swore they would never, ever buy corporates, and then they did. And they obviously bought a lot of mortgage backs as well. So that's what I mean about that dynamic of what some people call endgame, and when I shorthandedly or flippantly say it. From SS, would a 1944 style financial repression, aka negative real interest rates, be successful in 2025? Wouldn't social media make it hard, very hard, for any private or institutional capital to hold bonds at negative real interest rates? Wouldn't this also lead to very negative election outcomes? Yes, great points. I don't think you could do the post 1944 financial repression scenario of significantly negative real interest rates without capital controls in the United States and really around the world, and certainly not for longer than a brief period if you were going to try to do it without capital controls. And so ultimately, that's why, in the prior comment where I said, well, if the Fed or Treasury are forced into effective yield curve control, first they buy treasuries, then they'd have to buy mortgage backs, and then if they continued on, they'd have to buy corporates and so on and so forth, because ultimately you're gonna have to end up buying the whole bond market basically, because markets are efficient, and if you don't have capital controls, and those can be draconian, they can be regulatory. There's lots of different ways you can achieve that, but ultimately, to your point, in free markets, there are no suckers at the card table that are going to sit around and take significantly negative real interest rates, which is coupon on the bonds well below the rate of inflation. They're just simply profit-motivated entities cannot do so. And the amounts of debt we need to have negative real rates on are so big that it would bankrupt pretty much any profit-motivated entity on a real basis, and ultimately, nominally, were it to be pursued for any significant period of time. From RR, huge fan, Luke, thank you very much. How much of a fourth turning do you believe this really is, and what does the new monetary system we're transitioning into look like? Feels like wealth preservation at this moment has never been more important. How do us folks with families that have busted our butts at work for 30 to 40 years protect whatever wealth we've accumulated and not become collateral damage? It's a great question. I think ultimately, I absolutely believe in fourth turning, long cycle, Kondratiev cycle, whatever you want to call it, because ultimately they're just descriptors of human nature. What's happening has happened over and over and over in human history throughout millennia, and it's nobody's fault and it's everybody's fault because it's human nature. We do the same things over and over. And the cycle is really just a reflection of everybody that remembers the mistakes from last time die. And we're left with younger people who think they know better. And then they learn the lesson, and we all learn it, and the cycle repeats itself. So what does the system look like? Ultimately, we are the fourth turning, the long cycle. It is all about unsustainable debt and a political fight, hopefully just metaphorical and regulatory, not literal, trying to figure out who is going to eat the losses on the unsustainable debt. Will the debt be written down? Will the debt be inflated away? Will the debt be paid in real terms? And the standard of living of the debtors crushed? This is ultimately what these fourth turnings are about. Whose head is the debt going to fall on? And so, luckily, we can pretty safely assume they're not going to try to deflate to maintain the real value of the debt, simply because the debt cannot be paid in that case. So they need to inflate it away. There's different methods they can do that, and luckily we can protect ourselves by putting some wealth into physical gold, putting some wealth into Bitcoin. I think for this part of the cycle, I don't think it's crazy to have 20% of your wealth in some combination of gold and Bitcoin. For somebody closer to retirement, you said you've been working 30, 40 years. Look, Bitcoin is very volatile and can fall a lot in, for multi-year periods of time. So I think having some Bitcoin around is good. I think it needs to be a small part if you're close to retirement, more in gold. If you're younger, you can weather out that volatility, that inhumane volatility at times in Bitcoin, because you've got a lot longer to weather that volatility. So that's how I would think about that. Next question is from BB. Is it too late to take a position in gold? Time horizon is next 2 to 3 years. The short version is no, it's not too late. I think it's if your time horizon is 2 to 3 years, there are things that could change that view, but they would be very drastic in terms of political changes, economic changes, etc. To my eyes, it's pretty high conviction when you look out 2 to 3 years that the system is transitioning in a way towards a neutral reserve asset. And it seems pretty clear to me that gold is going to have some role in that. So I don't think it's too early if your time horizon is 2 to 3 years out. Next question from TMT. Number one, is a decoupling from China being attempted? In my opinion, yes. Number two, can the U.S. exert sufficient leverage on allies to stop trading with China? In my opinion, no. Number three, will the U.S. be able to simultaneously push long-dated bonds on allies as a price of admission to a new trade sphere? Low probability, or excuse me, no, I don't think so. Not without either revaluing gold significantly higher, one way or another, in my opinion, or the U.S. having some trump card up their sleeve, pun intended, where we have some sort of mind-boggling technology that allows us to say, look, if you're with us, you get access to it, and if you're not, you don't. And even that's tricky because once it's out there, the Chinese are going to have it pretty quickly, I suspect. So that's just the way things go, as we've seen. So I don't think the U.S. will be able to push long-dated bonds on allies as a price of admission without that technology trump card or without revaluing gold significantly higher. And then the fourth question, probability of success as you see it, and what can China do to thwart such a plan? To the extent that Besant's plan is to encircle China and cut them out, I assign a very low probability of success. And what can China and the reason I say there's a low probability of success is that, look, until the U.S. devalues its debt to GDP, China shut down its economy for a year, 18 months under COVID. They can take pain for 12 to 18 months. The United States bond market dysfunctioned after 4.5 days, and people that were saying we can take the pain were on X saying, help us, Jay Powell, help us, Besant. Maybe let's not go so fast. So the bond market, I've equated in writings for clients, the bond market in the U.S. is like badly broken ribs on an MMA fighter that the other professional fighter knows about. And so what's going to happen in that fight? Any time they can, the professional fighter is going to beat on those badly broken ribs and drop the weakened fighter to his knees. So if the U.S. wants to play hardball, if they want to fight, if they want to trade war, you can't go into trade war with badly broken ribs. And the bond market is badly broken ribs. You need to anesthetize the real value of the bond market first, or you will lose. And we started to see that. What does anesthetize the bond market look like? QE, yield curve control, revalue the gold and buy it down. Whatever you want to do it. Get it over with. But for the U.S. to win the trade war, the real value of U.S. treasuries must, I repeat, must lose. And in terms of what can China do to thwart such a plan, China can just sit tight. China can sit tight and let the badly broken ribs of the U.S., which is the U.S. Treasury market, continue to have issues. And then in another 2, 3, 4 months, once U.S. store shelves start going empty, China was locked down for 12 to 18 months. Americans fight over toilet paper in Walmart, back in COVID. So China can sit tight, and I think they can sit tight and wait for empty store shelves in America to become an acute economic and political issue. And so I don't, I think, I've said it since day one, I continue to think it. I think markets are mispricing leverage in the trade war. I think I've seen it phrased escalation dominance. I think China has escalation dominance in this, both because of the broken ribs of the bond market and because American store shelves are going to start going empty in I don't know, 2 months, 3 months, 5 months. I don't know what it is, but it ain't years. And China's locked its people down for years. And yes, they're facing deflation. Yes, they're seeing pain. Yes, their exporters are in trouble, and they have the goods. They're not going to be short stuff. So appreciate the question. Next one from JC. Luke, gold has played out as you predicted. Does silver follow as it normally does historically? Thanks, Jim. In my opinion, I think the gold to silver ratio, which I understand is historically high, is going to remain elevated and probably rise further over time. I'm not saying there won't be periods where we see the gold to silver ratio fall. So 100 now, could it go back to 90, 85? Sure. But I think in 2 years' time, 3 years' time, 4 years' time, it's going to be higher than 100 and maybe substantially higher than 100. And the reason I say that is because if I'm right, this is a sovereign debt recap. That's all we're talking about here. And a central bank recap. And sovereigns and central banks, they don't own silver on their balance sheets. They own gold. And so if they're going to recap, they're going to use gold, which means basically they're going to recap their debt positions using gold, which is nice because as everyone knows, as the detractors always say, gold isn't used for anything. Well, if gold isn't used for anything, they can take gold to some really big number to recap the unproductive and the sovereign debt on their balance sheet. And it doesn't affect the real economy because it's not used for anything. If silver were used in a recap, suddenly iPhones become unaffordable. Solar panels become unaffordable. All those silver applications in industrial applications become very expensive. And that drives inflation up, which is counterproductive if you're trying to resolve a sovereign debt issue, if you're trying to resolve debt recap. So that's why I think ultimately the gold to silver ratio is likely to be higher in 2-3 years than it is today. Now, I own a little silver. I think so. I like silver. I think silver will do fine. But I think gold is going to continue to significantly outperform silver over the course of this forced turning. From SH, dollars decline and bonds selling off. What do you make of it? It's capital outflow action. Full stop, especially with equities down. So it's dangerous for a country with twin deficits and needing foreign capital like the U.S. Long term, it will drive the rebalancing needed if it continues. And there are signs, as we've discussed, that the Trump administration wants it to continue in terms of some of the things they've highlighted. White House CEA Stephen Myron, the America First investment policy memo laid out by Trump in February, basically said, China, take your money, go home. The issue is the executional risk and the path from here to there, right? It's ultimately would be very good for the U.S. I think it would drive the rebalancing that Bessent was talking about again this week. But it's very, very dangerous medicine. It's a very toxic and powerful medicine. Painful best case, catastrophic, fatal worst case. So, let's watch. And the final question from JL in the December 17th, 2024 issue of Tree Rings, MicroStrategy in the queues, Bitcoin becomes big enough to become a reserve asset. Is that now off the table with China seemingly selling Qs? Very good question, and that did not play out the way I thought. I was wrong about that. Simply by virtue of, I couldn't have known that the Trump administration was basically going to put out a memo in February telling telling China they don't want their money in the queues anymore. That's a surprise, I think, to everybody. With that said, note that the Trump administration is still talking about using T-bills or putting T-bills into stable coins, using stable coins as a means to drive demand for T-bills. And obviously they've talked about the Bitcoin, strategic Bitcoin reserve. Left unsaid in all of that is that the higher the Bitcoin price, the more stable coin demand, the more T-bill demand there is, which is really that was the core of what we were saying and all that. So I think the vessel or the mechanism of MicroStrategy as Trojan horse to get China to help you bid up MicroStrategy, who then in turn issues shares and buys Bitcoin, etc., and in a virtuous cycle. I think that is off the table for now, at least. But I think the underlying theme of U.S. government desperately needs balance sheet and stable coins, and therefore Bitcoin can help the U.S. government find balance sheet. I think that is absolutely still in play, and that's why one of the reasons we still like Bitcoin over the intermediate and longer term. So with that, I'm going to finish up for the night. Thank you, as always, for joining me. If you like these updates, check out FFTT-LLC.com for more information about our tree rings product, 10 most interesting things, brief synopsis on each, what grabbed our attention about them, and how they are either confirming or changing a way we had previously been thinking about the world and what's going on in macro. So going to finish up for now. Thank you for joining me. Everybody have a great rest of your week, and we will talk with you soon. Take care, everyone.